All right, folks, welcome to Investing for Beginners podcast. Today, I have a new friend. We have Brad Freeman of Stock Market Nerd joining us today. Brad is easily one of my favorite follows on X and has been for a long time. Super smart guy that you're going to hear if you didn't already know today. And we'll talk all kinds of things about stock market and get Brad's opinions and viewpoints on a lot of great stuff. So, Brad, thank you very much for joining us today. I really appreciate you taking the time out of your day to come join us.
Well, thank you for the kind words and the warm intro, and I'm very excited to nerd out with you.
Yeah, all right. Yeah, me too. All right. So let's start with an easy one. You could pick anything to invest in: real estate, crypto, gold, bonds. Why stocks?
Yeah, I love numbers. I love fundamental analysis. So when I was in grad school and in finance school, just reading financial statements was something that was interesting to me. Not because of it's fun to do arithmetic over and over again, but it's fun to pick through the nuance and the context for each individual sector and to almost not be an insider because I don't have any information anyone else doesn't have, but to be in the know on what to look for and what matters and what puzzle pieces within the identical monotonous flow of financial statements we have are actually the pieces that you need to put together for each individual company. So I really enjoyed that, and I really enjoyed the fact that these people have to tell us how they're doing all the time. Maybe I'm investing in an artist who decides they want to go live in the rainforest for 5 years and not make art again and say, okay, well, that actually might make the art worth more. But you hear what I'm saying in terms of we get information from them every 3 months. We get progress reports, which makes it just very easy, not easy, but very doable to keep track of these companies and not only to do that, but to put in a lot of work to keep track of these companies, which a lot of people aren't super willing to do, which I think just creates an unlevel playing field, even within this just uniform base of data we're all working with. So I
Yeah.
love data. I love using it. I love putting it together and thinking about it. And yeah, so stocks.
Yeah, that's awesome. So, okay. So on a nerd level, are you like a scale of 1 to 10? Are you like downloading PDFs and reading them on your iPad in bed before you go to sleep? Are we that obsessed?
I used to be, but I've tried really hard to like 8 o'clock. If it's earnings season, there is no work life balance. But
Yeah.
outside of working, I try at 7 o'clock, 8 o'clock, whatever time I want to pick realistically for a day. I try to be done so that I can just not kind of get burnt out. But a lot of the day is spent reading filings and reading investor conferences and presentation and listening to old investor appearances from companies that I'm interested in. So it's a lot of reading, and then yeah, it's a lot of distilling and thinking. So I
Yeah.
think it's pretty fun, and I know you do too. But so that's
Yeah. Yeah. Yeah, I do. My wife sometimes look at me. Are you working? It's 9:30 at night, and I'm reading a 10K from some company. I'm like, no, it's fun.
Yeah.
It's fun. All
Yeah.
right. So I
Some light
guess
reading,
how,
but okay.
yeah. How did you develop your framework? Like when you think about companies, I know you have companies that you follow at 50, 55 companies. Like how did you develop that framework of these are the kinds of companies that I'm gonna
Yeah,
investigate?
I'd say a lot of trial and error, and I think there will be more trial and error and failing and learning and refining for my entire life. I think everyone probably will be doing that, hopefully, if they have an open mind. But I think just the beginning of investing for me was not something, I don't think responsible is not a word that I would use for it. It was in 2019, wrapping up undergrad and heading into the pandemic and not having much to do at work. And then, well, there's no sports on anymore. So, oh, these stocks are cool. I'll buy, well, that options, that sounds fun. So, and I was very poor at the time, which I am very grateful for in hindsight, because it was a very destructive approach at the very beginning. And then I have great mentors, and just them knowing me and knowing that I wanted to be in the financial world and wanted to do something similar, and then seeing how far away I was from doing it in a sustainable manner. And then just being very loud and aggressive in my ear of you need to change and you need to refine. And then the pandemic bubble, another really good learning experience of just and there's a lot of parallels to what we're seeing today, but just the seductive noise of the highest flyers and the most expensive companies and the shiniest objects on Wall Street, and just having the conviction to stick to your process, the discipline to stick to your process, and the understanding that 100 times sales, these $20 billion science experiment projects that have that have headquarter buildings that look like my apartment maybe aren't the best way to sustainably invest, and just really focusing on I want to outperform the S&P 500 very boringly over a very long period of time, and not which different than 2021, not trying to extract as much outperformance as I possibly can on the way up, but taking advantage on the way up, and gearing up, and positioning myself and taking some risk off the table while things get more and more and more ridiculous, so that I'm buffering losses and buffering the declines that inevitably come on the other end, while having no feel for when that's going to happen, but just making sure that I'm not caught with my pants down when it does happen.
Yeah, that's a great philosophy. So how did you get burned along the way, and that's what helped you? Okay, I need to change what I'm doing.
Yeah, I think I had $1,500 in a Robinhood account when I was 20 years old or something like that, and lost all of it very quickly. And then I think I had the nerve to go to my brother and be like, "Hey, I think I can do this." And he, one of the mentors, being like, "Can I see your account and can I look at your history? And you're an idiot, and you have so much to fix, and get out of my face." Basically, was older brothers are the best. Yeah.
Yeah, thank God, right?
I'm very grateful for that conversation, for sure.
Yeah, I bet. All right. So how did you go from that to where you are now today? Because frankly, that's not that long ago.
No, it's been, I guess,
so that's quite the transformation.
yeah, 8 years. So it's been a lot of just iterating and tweaking, and learning from people, and reading Warren Buffett's material, and Peter Lynch's material, and Brian Feroldi's material, and all of these people, and just not emulating everyone, and not emulating anyone, but maybe emulating Peter Lynch a little more closely than other people, but pulling I like that piece of your philosophy and that piece of your philosophy, and kind of in a similar way of evaluating financial statements, putting your own process together in kind of a puzzle-like manner. And it takes a lot of reading, takes a lot of learning, takes a lot of failing, and just slowly getting better over time, and just getting better at understanding what matters, and what is signal and what is to be ignored, and respecting when it is signal and that shouldn't be ignored, and just making sure that it's all those things. And I think the other important thing is just keeping a very open mind with every company you have. I think in 2021, there was a lot of dogmatic language and across social media, and everyone never sell, and if you do, that's sacrilegious, and me having to apologize up and down for trimming 10% of a company that tripled in 3 months. I think it's just getting away from that unconditional loyalty that sometimes is tempting to feel to a company that's made us a lot of money over the last few years, and coldly treating them as in a "what have you done for me lately" type manner, and making sure that fundamental prospects are still very good, fundamental execution is still very good, runway is long, taking advantage of it effectively, all those things that we look for to make sure that we're not growing complacent in these names that have treated us well, because there's no guarantee they're going to keep treating us well. And if there are clear signs that they're not, it's a lot easier to get out earlier than if we're ignoring those signs.
Yeah, for sure. So couple questions spring to mind. So number one, like the whole idea between identifying signal versus noise, especially if you're on social media at all, it can be very loud. So how do you fight against that?
Yeah, I think so. So I'll talk about two companies, I think, for this. So Uber, a year ago, Tesla is they're dead. It's if you go on X or social media, Tesla they're going to get 100% market share in AV. Uber's done. They're a dinosaur. I think Meta was a great one 3 years ago, where you're existing on X, a social media rival to Mark Zuckerberg, where people maybe don't like Mark Zuckerberg as much as they do on Instagram, and just thinking of dead in the water. So I think it's paying close attention to who we're surrounding ourselves with. And for me, Twitter is the best source of top of funnel marketing out there by far, times 10. So I need to be there, but I need to be there while taking everything that I'm reading with a large grain of salt. There are very bright people like yourself who are on that app and have great things to share. And there are a lot of people with agendas and with subscriptions to sell and capital letters and rockets to write, feathers to ruffle, just to create signal and create sensational, or to create signal fog and sensationalism that makes everyone concerned and nervous and anxious. And I need to sign up for this person because they seem to know what they're talking about. So it's that. And then it's also just, I think financial statement 101 education is extremely important. But then in getting back to that nuance and context we're talking about, using Uber again, for example, net income is the holy grail for income statement profitability for so many companies. And for this one, it is utterly irrelevant because they have an equity portfolio and they mark gains or losses on that equity portfolio every single quarter. And net income is a byproduct of how the stocks in that portfolio went up or went down. So it's for a company like that, net income is irrelevant. For a company SoFi, free cash flow is irrelevant, because if I'm adding loans to my balance sheet and using cash to do that, that's cash burn, and free cash flow looks terrible. If I have no more liquidity and I have to sell my entire loan portfolio because I'm not doing well, free cash flow looks amazing. But it's not something that we should be excited about, because it's a signal of very structurally dangerous and damaging things that are happening. Not saying that's happening in SoFi, it's not, but just hypothetical situations. So it's just it's learning the cookie cutter rules for financial statements, but then it's going a step deeper in terms of sector, in terms of individual company, what is truly important here and what is truly not important. Because somewhat frustratingly, under GAAP accounting rules, it is different everywhere. So yeah, I think yeah.
Yeah, it's incredibly annoying, especially a company that I own, Berkshire Hathaway, right? Their earnings can be fantastic or horrible depending on how the stock market is performing. And then people are freaking out. Buffett's losing it. They're down 50% earnings. I'm like, oh, come on. Have you not read? No, you haven't read. So you don't understand. I get it. So yeah, I love that analogy, and I love that example. I think that's a really good illustration of, you have to understand the financials, but you also have to go a step further. I think if you don't, you're going to be in a lot of trouble.
Yeah. And you're going to get really excited about things that are not exciting, and really nervous about things that are not things to be nervous about. So
yeah, for sure. Okay. So your analysis is famously thorough. I think that's an understatement. So once a company is on your radar, let's say Datadog, like, what does day one of research look for you if you find a company like them?
Yeah. So Datadog, great. Like Rubrik, I just was the most recent investment case that I wrote. So I'll just walk through that. But there's a lot of reading. And I will say, for companies like that, the AI bots are terrible writers, and just, it feels like cheating using them for writing. But for a company like that, where there are new concepts to me and new products to learn, it's super helpful for me to say, hey, Gemini, here's my understanding of this concept. Where am I right and where am I wrong? And have them tell me, this is right, this is wrong, here's a source that explains it to you. It just gets me to information a lot more quickly. But aside from that, I love primary sources. So reading the last 4 or 5 earnings transcripts, maybe they made some promises 2 years ago at an investor day, and we can see how their performance is shaping up versus targets that they've set. Going to Glassdoor and things like that, but third-party review sites are notoriously noisy in terms of, you can tell your employees to go pump in some good reviews and make it look good. So maybe focusing on those things less, and focusing more on both what Rubrik's actually doing. And then you had, for this company specifically, you had other firms like CrowdStrike and Okta announcing big partnerships with them in the last few weeks. So going into those events and learning how these companies are working together, how they're collaborating, how they've carved out complementary niches, but maybe in some places they're starting to overlap just a little bit. So it's very much so reading everything that Rubrik has made available to us, because the 5th investor conference you read, another frustrating part of investing, 90% of it's going to be the same as the 2nd, 3rd, and 4th, and then they're going to tell you one new thing that you feel like you would have missed if you didn't read everything. So it's going through all their investor materials, and then it's just talking to not selfishly, but one of the luxuries of running this newsletter is there's always 4 or 5 really smart people with 20 years of cybersecurity analyst experience who have been using Rubrik and their competitors for 10 years, and can really intelligently comment on the pros and cons through their own direct experience of using these products and using other products. And for me, the generalist, I need those people in my life. I need them to tell me, hey, Rubrik is sometimes more expensive on a workload basis, but usability and resilience is so good that's why they do so well with large enterprises, because they're less cost sensitive and they need it to work when they need it to work. I think going through all the investor material and then filling in the domain level knowledge gaps with other people who I've met over the last 8-9 years of doing this. And then again, I think the chatbots are really good for, here is my understanding of a concept, and pick apart where I need to have a different understanding of this. I think they're excellent at that, and making sure that I'm more confident that everything that I'm saying is 100% accurate, but also using Gemini, ChatGPT, and Perplexity and cross-asking, because they hallucinate all the time, and you need to make sure that the answers mesh. And that's what, for chatbots, the use case that I found most valuable is, I think I know what the right answer looks like. Here's what my understanding of the right answer looks like, it confirm that I'm right, or am I wrong? So that's helped me expedite a little bit, but still so much reading and so much learning, and several days and weeks of just learning the ins and outs of a company. And for Rubrik, it's not that I'm not going into these research processes saying I want to own this company. I'm saying I'm going into the process saying I want to learn about this company, and if evaluation's right, if the price tag is compelling, I want to put myself in position to confidently buy shares in this company when if the stars align. I want to be ready to pounce. And for me, it takes knowing it like the back of my hand.
Yeah, that's awesome. All right. So how do you move? This is something I've struggled with, is how do you move past the tech gap? In other words, when you're looking at a company like CrowdStrike, how deeply do you feel like you need to understand what it is they do to be able to analyze it and potentially invest in it at some point?
Yeah, I don't think I need to get down to like the source code kernels. I don't even have access to that information. So if I did, then I would have to just leave enterprise software alone. But I think I need to be able to intelligently comment on, here's what this product does, here's how it integrates into the rest of the suite, here's what the use cases are, here's the core value proposition versus the other 5 substitutes that are on the market. I need to be able to do that. It's nice when CEOs tell you that they're better than these 5 competitors, but especially for cybersecurity, if we're talking about that industry, they are all so charismatic, and so we're the best and everyone else sucks, and then we're the only one who can help. But it is really leaning on all the resources that I've built over the last 8 years, and learning from these people and going very slowly in learning, because sleeping on some of this information helps me absorb it and helps me ingrain it in my memory bank and be able to talk about it more intelligently. But I think the litmus test for me is going on a podcast like this and you saying, okay, what's if you want to do that, we can do that, but happy to. What's Rubrik? What do they do? And me being able to not just fire 50 different buzzwords at you to make that I've memorized to make me sound intelligent, which I will use the buzzwords in my writing, but I will always define them because I think that's just way more valuable. But it's like Albert Einstein. If you can't explain it to, is it 6-year-old or 8-year-old, one of the two, then you don't understand it yourself. And I truly believe that is true. Yeah, it's an unorthodox way to piece this information together, because I can't say, hey, CrowdStrike, I'm a potential $1 million ARR client. I want to demo your software with your engineering team. They'll say, what is Stock Market Nerd? Like my older brother, they'll say, get out of my face. But I can talk to other people who I trust and who I know don't have any kind of conflict of interest to tell me anything's better or worse than it actually is. And that's super helpful for me piecing things together.
Yeah, that's awesome. All right. So how much, we've danced around the reading topic. How much do you read a day, a week, if you had to try to compile that?
Yeah, see, it's funny. I'm in finance, but my entire day is reading and writing. That is all I do. I'd say, and it's all reading and writing and podcasts sometimes, but I'd say earnings season, it's wake up and read. I don't ever feel like I finish weekly articles in earnings season. It's just to get as much done as you possibly can, and then at 3 a.m. on Friday night, you can go to bed and have 36 hours to get ready to do it all over again. But I do love non-earning season, and I get fewer subscribers, fewer followers, fewer engagement. But to me, it's just like a big exhale and a big recharge your batteries. I don't think I work more than 40-hour weeks outside of earning season. I think it's a pretty typical traditional like 9 to 5, and why I like it so much is because I get to say, okay, I have these eight pieces on Rubrik that I need to read for the next 2 weeks, not I have these 8 pieces on these 8 different companies, and there are subscribers expecting an article in 4 hours. And if they don't get it, they'll probably that some of them will be a little bit annoyed. I'll get fewer conversions. So there's just less pressure, which is really nice. 2 more weeks and we'll be right back into the pressure. But I think it cycles between work all day, every day, and then pretty traditional work hours outside of earnings.
Yeah, I can appreciate what you go through. I don't have to read quite as much because I'm not focusing on companies as deeply as you are. So what is your note-taking process like? Are you a note taker?
Oh yeah. So an earnings review, what I will do is go back to the previous 2 earnings reviews and just pull highlights and context, and maybe quarter over quarter growth figures or net whatever figures, so I can compare them on a sequential basis quickly without having to go back and do things. So all the prep work is making sure all the charts that I have are ready to go, and I just have to plug in the data. All the previous qualitative conference call cues are ready to go. And then having that all just organized. And I'm a big fan of bullet points. So you just sectioned off and write it in so that I can just control F and find whatever I need when I'm talking about a specific topic right from that document, which just saves me a lot of time. And then it's usually, well, press conference, shareholder letter, sometimes like Uber always has prepared remarks that are different than the conference call, which is a little weird, but they're Uber, they can do whatever they want. It's reading all those investor materials. And then I used to love listening live to conference calls, and I would get I am the type of reader who, if I feel like I missed something, I have to go back a sentence and read it 3 more times. And I just would feel like I missed 20 different things. And I'm basically, I just have to read this again at this point. So I do love listening to transcripts, quarter or whatever, and listening on 2x speed. There's so many different vendors to help you do that. So that's a good one if you want to check it out, or for listeners if they want to check it out. But listening on 2x speed, ironically, it doesn't make me feel like I'm missing things any more than hearing it live on 1x speed. But it's just, if I'm reading or listening and reading along, it's copy and pasting important passages under bullet points. And then once I'm done, having all that information there and just taking, I guess, a few 10, 15 minutes to organize it into sections that I want to write, and then turning all these bullet points and quotes into ideas and thinking through them and implications and all those things. So it's gotten pretty step by step, which has helped me, I guess. Just routines are always nice when you're getting through this stuff. Makes it a little less overwhelming and a little bit more habitual and easy to get through and easy to check off progress as you're doing it. But that really is the process I have. The only other thing I use AI for is I don't even know if this is AI, but there's probably some kind of something, but it's called Quillbot. I have a contract editor who I'll send this to. He'll send it back to me and then put it in Quillbot, and it shows you, this is spelled incorrectly. A comma could work better here. So that's super helpful for me. There's always 2 or 3 typos that I read 2 weeks later and just want to pull my hair out. And so, AI finding that for me has been helpful as well.
Yeah, that's awesome. I use Grammarly for that kind of thing, and I've been using it for years, and it saves my bacon every single time I write something, because misspell something, quotations, all that stuff, wrong place constantly.
Yeah, it's funny with AI, but it's just more machine learning is what we're
right.
Machine learning for a very long time.
Yeah, a big fan of that stuff. Okay, so when you're a good writer, you're really good at communicating clearly complicated things. So like writing about finance is not easy. And there's, as you mentioned earlier, there's a lot of jargon, there's a lot of buzzwords. You do a really good job of making things clear. I distinctly remember reading your PayPal write-up many years ago, and I was newer to that company, and it all made complete sense. And it was very thorough. It was very well written. I could tell you were excited about the company, but you were
unfortunately
measured. Well, yeah, so was I, but anyway, sort of bag holder here. Anyway, but how did you develop that? Is that something that you think was innate in you, or did you learn this in school, or is it just because I've been writing so much for so long that I've just gotten better?
My mom is a phenomenal writer. So she was my K-12 editor, helicopter mom of, I would write essays and she would edit them, and probably with more of a heavy hand than was maybe appropriate. But she was an English major at Michigan. She's a phenomenal writer. All the flowery vocab that I use sometimes, credit to her, and just great parents who just gave me a phenomenal education and gave me a lot of support and a lot of help and a lot of knowledge, and held my hand without carrying me to the finish line, but just supporting me and guiding me. So great parents, shout out to them if they get a chance to listen to this. But so I think it's extremely important to use the lingo, but to always define it, to not to use it in a way where you're trying to casually just off the cuff mention it and assume that people understand what you're saying, but using it so that they know that when there is someone on CNBC or someone else or some other technically inclined industry insider talking about things, they'll be able to recall those words and understand what they mean because they got a simple definition. So it's combining just really straightforward relationships and between complicated products, and not here's what the source code does, but here's what the end use case is trying to do, and here's what the problem is that they're trying to solve in a way that everyone can understand, while also incorporating those buzzwords sometimes in parentheses or in bullets saying, hey, if if you hear someone using this word, this is what they mean and this is what they're talking about, which I think for people is really valuable. It's extremely valuable for me, and hopefully it is for others as well, because they feel like they can talk. They now feel like they can talk the language of that industry insider without spending 15 years cultivating the knowledge, and while understanding the relationships and the cause and effect of what they're actually talking about.
Yeah, that's cool. All right. So I love that your parents were supportive and helped you. That's
They
an
rock.
amazing, yeah,
Yeah.
that's an amazing leg up for you. So kudos to them. They did good. All right. So how do you identify a nerd stock pick? Like, how does Rubrik come into your ecosystem, and how do I identify those kinds of companies?
Yeah. So it's, again, the luxury of having a newsletter with a lot of bright, passionate, motivated investors is they will constantly bring me, hey, look at this
Ideas.
company. And I will look at them, and 9 times out of 10, it's just not for me for whatever reason. But that 10th time, the company that is operating in an industry with an extremely long runway, that's going to be a structural growth darling for a very long time, with one of the most recession resistant enterprise software budgets out there in terms of spending on cybersecurity and cyber resilience versus anything else. So opportunity, very good. And then just seeing how a company exists within that massive opportunity. So we'll use Rubrik as the example. So for cybersecurity, we've all I guess come to understand, people who invest in it. The big three: it's network, it's identity, and it's endpoint, and then cloud security you can call forth, but it really just it is tied to all three of those very intimately, and it's hard. It's not really a separate category, but it's just separate workloads within that same category. So pretty much the same thing. And then seeing this company called Rubrik, and there are others, Cohesity and Commvault and a few others, that have maybe not a fourth cybersecurity pillar, but a very separate and complementary bucket that they've carved out within this large industry, where they're not pissing off CrowdStrike, they're not threatening Zscaler, they are partnering and tightly integrating with all these world-class leaders that I've studied for a long time. And to me, when I saw that, it was like, oh, well, this is so CrowdStrike is not building their own data backup vault or immutable data backup product that I know that they see how tens of billions of dollars in total addressable market. They're all trying to encroach on each other's territory because they're all trying to extend growth runways. And no one is really doing so that passionately with Rubrik. They just deepen their integration, again, with CrowdStrike and Okta, very close partners with Palo Alto. CyberArk, they have not gotten a partnership inked, but Palo Alto just bought CyberArk, so you think that's going to happen. And seeing just how large of an opportunity they play in, and how little stepping on other toes they've done in terms of collaborating with all these companies and ensuring that they're sharing data, so that their data recovery processes are even better, so that CrowdStrike's endpoint security is even better, that Okta's identity security is even better. And then getting away from that maybe qualitative and somewhat abstract idea, and then just looking at numbers and seeing. I don't love relative valuation unless you are using very close peers, because just there are so many different compounding variables that can lead to valuations being different among sectors, and that will just always be the case. But when I see a company, I could pull it up super quickly, that I'm just, there's a chart on my mind. So just like from an EV to gross profit standpoint, which Rubrik is in that impending EBIT inflection point of their profit journey. They're about to turn EBIT positive, so have to use gross profit, which I ideally wouldn't be using. But you look at forward gross profit multiples, and Rubrik's at 15. The only two that are below it are SentinelOne and Okta, and they're outgrowing them in terms of forward gross profit CAGR convincingly. And then if you look at forward 2-year gross profit CAGR for Rubrik is 25%. For CrowdStrike, it's 23%. Rubrik's at 15 times forward gross profit. CrowdStrike's at 30 times forward gross profit. So that's not something that I'm looking at and going, okay, I'm buying right now. But it is something I'm looking at going, okay, we've evaluated the competitive landscape. It seems like they're playing very nicely and growing very nicely without upsetting anyone. And they're half the price of another leader in a different category, probably because CrowdStrike's EBIT margin is 20% and Rubrik hasn't broken even. But if you look at just how much they're having to spend for this incremental growth, writing is on the wall for that continued operating leverage. So quantitatively, I love deals, especially for high quality companies versus other leaders. Sometimes for SentinelOne, there are reasons that it's a lot cheaper than CrowdStrike, but for Rubrik, when it is a lot cheaper than a CrowdStrike, but then you still see them beating and raising every single quarter, growing revenue above a 30% clip, delivering really convincing and an exciting operating leverage. And then seeing them jumping up into the right on third-party research organizations like Gartner and Forrester, just a lot of different things going for it that prompted me to then say, I need to learn about this company. I need to learn what they do. I need to learn where they're going, what they're trying to do, where the team comes from. So it's a preliminary dive. And if there are a few light bulb moments, oh, that sounds pretty promising, and whoa, that sounds pretty promising too. It's okay. Then I need to go read everything, and that's what happened in this case. So I can just, it's not a holding right now, but it is a name like a ServiceNow or some of these other really high quality enterprise software firms that I deeply admire, that I have done the work to know that there's a forward valuation, a forward growth multiple in my mind that I have, that if it gets there, I'm going to be confident and ready to pull the trigger, and I'm not going to have to then spend a lot of time learning it. So yeah.
That's awesome. It sounds to me like you've built up in essence, a wish list, and that you work through that wish list very consistently so that when you do have an opportunity, you can pounce.
Yeah. And I guess other items in the wish list that are not at all unique, just a pretty balance sheet. I love when a company is not spending all of their free cash flow or spending all of their potential free cash flow on debt servicing. Yeah. Dilution is something that you'd like to not be egregious, but for a company like Rubrik that's gone public within the last few years, there's just still founder grants and rewards and all these things related to the IPO that I'm a bit more patient with, not considering that a deal breaker for companies that are early on in their public journeys, especially if they're printing a ton of cash, because then you just know down the line they're going to be able to shrink that if they want to. So yeah, it's I think I should stop rambling and leave it there.
No, you're good. You're good. So you mentioned like a red flag or maybe a hard pass. Is there, let's say you were looking at Rubrik. If you came through something when you're looking at them, is there anything in particular that maybe not company specific, but just a general rule? If you come across something, no, I'm out.
I think so. We're public market investors. We all have the same access to information. We are all woefully, or it can be woefully, reliant on executives being candid and telling us things that can be believed and can be counted on, relied upon. There are two companies in portfolio in my mind right now where I fiercely trust the CEO because I have 10 years of data to support trusting him being the right decision, and him saying something about 2026 and sell-siders not believing him at all and punishing the stock because of it. And just it's building that base of trust with these executives and these leaders, because I think Anthony Noto is the CEO of SoFi. I know you know that, but maybe there's someone on the listening who doesn't know that. Said once, and I know it wasn't an original quote, but it really stuck with me. An A+ leader can overcome a C business model, but a C leader can ruin an A+ business model. So I am completely and utterly reliant on being able to trust CEOs and being able to not second guess when they're being candid and when they're just trying to promote their stock. And it's a lot easier to weigh that trustworthiness when we have long public histories with this company, and we can go back to their 2021 investor days and see, what did you promise me was going to happen and what did you actually deliver, and look at their long track record of results versus expectations and estimate trends and revisions. But if I don't trust you, then how can I look at next 12-month profit estimates and what you tell me to expect and form a valuation and an idea of what your company is worth and have any confidence in that being accurate or useful? I mean, you can't. So with CEOs that I don't trust, the leash is extremely short. If you burn, it's the Charlie Munger quote: reputation is built over a lifetime and lost in 10 minutes. And if they burn trust, I'm not only selling it, but it's not even going back on the watch list or the coverage network. It's just I'm done. So yeah.
Yeah, that I love that. And as I've gotten older and I've got more experience, I've come to appreciate how much impact CEOs really can have on it. So if you had to weigh how much importance that has in an investment, do you feel like that has a greater or larger impact on? I'll pick on a company I own, Visa. Visa has become a company where you could have a ham sandwich run it and it would still do well. I'm joking, of course, but you don't really need Anthony Noto to run Visa, right? And so, like, how much does that factor into your decision making?
Yeah. So it's there, and there's a more annoying nuance and context. So maybe for a company like Google,
it depends.
where you could have a ham sandwich probably running that company with how brilliant and how deep of a bench of talent they have. And Sundar is not he's more of a roast beef sandwich, definitely better, or like a Wagyu sandwich.
Right.
He's a very capable CEO. But for a company like Google, it's still very important because I mean, great company versus, it is still important, but it is more important for a less proven company that has much more of their growth ahead of them and much more proving to do and winning to do, making sure that there is just a superstar CEO in place. But that even extends to some blue chips, like a Starbucks with just absolutely atrocious leadership in place for a while. I don't even think Howard Schultz you can really call a great CEO. He was fine, but basically now that CEO Brian Niccol has come in, and you see what he did at Taco Bell, and then you see what he did at Chipotle, and you see all of the terrible decisions that were made that are very straightforward to fix and to undo. And now you see an A+ CEO coming in and replacing an F- CEO kind of. And so, that's for an investment case for Starbucks. That is the entire investment case, because the business model, that's not going to give you 20% revenue growth for the next 10 years with ARR, with a ChatGPT integration and smooth ARR. I mean, and quick service restaurants is a declining category in the United States. The volume is shrinking. So if you want to grow and if you want to do well, you have to start from a place of almost doing horribly and then fix it. And so it's just getting back to that first point of every company and every situation is different. It's all, which is, I know, annoying answer for a lot of readers, because you want formulaic rules, but I think being willing to bend those rules and apply them in different ways is important for investing.
Yeah, I totally agree. Like, how would you deal with Anthony Noto leaving SoFi? Kind of like what happened with Mark Leonard leaving Constellation Software. Like, how would that really impact your decision to hold that company? And I'm not going to hold your feet to the fire. I'm just curious how much.
A company like that, I think it would make me significantly less confident in especially if he took another job at a bank I viewed as not as compelling of an investment story is SoFi. Like if a COO leaves a job and gets an amazing CEO job and a giant pay raise, I'm not going to be concerned about that. Good for you, you earned it. But if a phenomenal CEO who I think is powering the bull case makes some kind of horizontal move to a different company, that will definitely ding the confidence and ding the conviction. Yeah, for sure.
Yeah. I feel very similar. A big reason why I'm so bullish on Nubank is David Velez and his leadership. And if he left the company, it would. I have faith that the COO and other people know their stuff, but he really, to me, is the driving force. And if he's gone, it'd be a lot harder.
Yeah, like Toby Lucky, Charlie at Shopify. There are just generational founders who make me much more comfortable with owning, because I know they are going to yell and scream, maybe not yell and scream, but they are going to push and push and push as aggressively as they need to make something that could break work anyway. So and you saw Zuckerberg do it in 2022 with TikTok trying to destroy their business, and same exact time Apple saying you can't use our data anymore for your tracking, and them basically having their entire ad business blown up and half of their engagement jeopardized, and him saying we'll figure it out, and them figuring it out. So I don't think a lot of people would have figured that out, but he did.
Yeah, for sure. So how do you feel about, we haven't talked about this much yet. How do you feel about the V word, valuation? Like how does that play into what you do and how do you try to think through it?
Super, super important. So I won't really exit a company if I think they're getting ahead of their skis, but I'll take it from 6% to 2% of holdings and just make it a much smaller piece, and then cross my fingers that there's another opportunity that surfaces that lets me lean back in. So forward valuation really does dictate a lot of the accumulate, trim mentality for me, because risk reward inherently deteriorates as companies get more expensive, and the opposite happens. Valuation is a big part of forward returns, and especially in today's market, they violently fluctuate. So not taking advantage of that, I think, while I'm staying mainly invested, while I'm keeping core holdings in place, I think is a way for me to be a little bit more of that active manager while still embracing the long-term, I want to hold this company hopefully for a very long time mindset. But beyond that, for most of the companies that I'm looking at, I'm not really, I do, this is where the Peter Lynch emulation really is the strongest, but I love growth multiples. So I love crediting, if a company trades for 100 times forward earnings and they're going to compound earnings at 100% clip for 3 years, that's cheap. In my mind, that's cheaper than a company trading for 20 times forward earnings that's going to compound at 5%. So it just, earnings growth is the earnings growth and then path of revision trends, so that we know those estimates are solid and could even be going up, or they're maybe fragile and are probably going to keep going down, are two extremely important parts of valuation for me. So making sure that I'm crediting companies when they are growing profit faster, because that is the single most important determinant for future returns, and maybe not ignoring, but stomaching and being okay with a company like CrowdStrike a few years ago that was trading for 500 times forward earnings because they just turned profitable, and you're dividing by a penny, and that penny's going to turn into 50 cents next year, and then $1.50. So it's using all of that added context to not ignore traditional valuation framework, but to augment it with a few other variables that I really like using. And just one other note I'd say is I use PEG ratios, so price to earnings divided by growth. I know you know that, but in case a reader doesn't, and sometimes, and I'll use either net income or operating income if it's a better metric for a company like Uber, or free cash flow if it's a better metric for a company like CrowdStrike. And sometimes we talked about how for some companies free cash flow statement is worthless. For other companies, income statement gets really noisy. But for most, it does make sense to use one profit metric from both statements, just to make sure there's no unscrupulous add back happening, nothing weird happening in calculation, and they should mesh pretty well. And if they don't, well, let's dig deeper and figure out what's going on. But I do love using those growth multiples, and I do love using multiple years of growth compounded when I am calculating them, because sometimes, especially for extremely smooth, boring structural compounders, you can have 80, like for MongoDB, where they've had this really large licensing on-premise headwind to profitability for the last couple of years. So they've had zero, they're going to have something like 0% earnings growth this year, and then 90% next year. I'd rather treat that as whatever, 45%, whatever it is, compounded over 2 years than saying their growth multiple is a zillion this year and it's 0.1 next year, right? So it helps with diminishing reliance on a single year of profit growth, which can get noisy for various reasons.
Yeah, that's awesome. Okay, I like that framework. That's I haven't used. I'm a fan of DCF, so I'm boring
For sure.
And I like those. But I always like to hear how other people are looking at that, because I think that to me becomes a lot of the art of investing is figuring out the valuation.
I will do some modeling, but there's always it's going 3-5 years out. I always have the caveat, just so everyone knows, this is probably wrong, and I'm giving you 7 different scenarios because we are making educated guesses on all of these variables. So I do think modeling is super helpful for gauging like range of scenarios and range of potential outcomes. I think that's super helpful.
Yeah. So do you have a market cap size that you prefer? And then the second part of that, which is not related, but is, how do you think about geographies? So are there any geographies you're like, no, I'm out?
Yeah. So in terms of market cap, I guess I range from like 4 billion to a couple trillion. So kind of a big, I do think that my batting average with very small companies, sub $1 billion market caps, has been pretty bad in my experience. I've done poorly with that, and I've done poorly with healthcare. So those two areas of investing I've shied away from, and maybe taken them out of perceived circle of competence just to focus on the things that have treated me better. So I would say there are no market cap rules, but the bar for investing in a very small company would be extremely high for me right now, because just because I haven't done very well with it. But so that, and then in terms of other geographies, China is a kind of a no touch for me. And it's detrimentally so this year, because wow, have those companies perform well. But in terms of just like great leaders and sleeping well at night, and getting back to that idea, when they're as reliant on government policy as they are there, and it being favorable, and that government can do whatever the heck they want to do to companies. We saw it happen with Jack Ma disappearing for a little while. That was that was probably the most powerful businessman in China. And to me, that was just I hope the companies do well. I hope everyone makes money, and I'm going to watch from over here. So in terms of geographies that I do have interest in, I think Southeast Asia is extremely interesting right now. Korea is super interesting right now, just from not from a population growth and GDP growth perspective, but they are very far along in terms of modernization and the infrastructure to support more e-commerce penetration and more of all those things is very clearly intact. And then Latin America. I think Latin America is extremely exciting too, because in some places, not in all places there, you do get the population growth factor for growing GDP. You do get a demographic shift that is 10 years behind in terms of e-commerce penetration, in terms of digital financial service penetration for customers that are when looking on a global scale, especially in Brazil and Argentina and Mexico, where a lot of these companies are playing, GDP per capita is pretty compelling. And a combination of them having a pretty decent amount of money to spend and not having great products yet in place to spend them is pretty ideal for a company like Mercado Libre, or C Limited is now entering Brazil pretty aggressively. Nubank, boy, I know you know a lot about. But philosophy with venturing outside of the United States is pick the absolute best company you can possibly find. Pick the highest quality blue chip. Do not go bargain hunting, even though you did get to go bargain hunting on New. Well, that was the best company out there. But
Yeah.
just blue chips. I want the absolute best of the best leadership teams, best business models, most entrenched companies, most beloved brands. Because when you are exiting the United States, accounting irregularities get more frequent. Just geopolitical risk is higher and less understood by a Michigander like myself, who has left the country a few times in my life and I haven't lived in Brazil. Like, I know you have more experience with that. I don't know I don't know how personally you get with your subscribers, so maybe.
Oh, I tell them everything. So
yeah,
they know.
You've been to Brazil and you've seen that, like we were talking about before the episode, that purple card army, which I love hearing from people who have been there. So thank you for that context. But yeah, I love the highest quality companies outside of the USA. That's like, similarly to, I don't like small caps and I don't like healthcare. The bar for investing ex USA is very, very high for me, which means the most special, disrupting, high quality companies are the only ones I play with.
Yeah. I think that's a great philosophy. And not only does that help your returns, but I think it also helps offset some of the risk that could be, to your point. I don't live in Colombia.
Yeah.
And so I don't know what's going on the ground there. And I can play that I'm Brazilian. I'm not, but I've been there twice. My wife is Brazilian. So I have maybe some insight, but I don't live there. And so I think having the ability to offset that risk by buying the best companies you can, I think could help mediate or alleviate some of that.
And for non-US listeners, there's accounting fraud that happens here all the time too. I'm Trevor Milton rolled a truck down a hill and called it a demo in 2021. But I have more confidence in seeing that more quickly, in understanding it more quickly, and doing something about it, and risk managing with a US based company than I do with a company across the world.
Yeah, I totally agree. So I guess my last question is, if you had to look into your crystal ball, how would you play out what you think is going on with the whole AI thing? Because that's what everybody and their brother wants to talk about. And people are asking us constantly, what are you investing in AI? And I'm not going to ask you to name names, but just how do you think this is going to play out if you had to give us a guesstimate?
Yeah, I think a lot of the companies we're talking about right now, we will not be talking about in 4 or 5 years. I think there are a lot of similarities to pandemic bubble, to .com bubble. I think the similarities are a bit more local right now in terms of refined to pockets of markets. And the craziness is not, in 2021, it was every enterprise software name gets 20 times sales, and enterprise software is a gigantic piece of indexes. But right now it feels like that is confined to that's confined to AI infrastructure and quantum computing, and these 20 quantum computing seems it's hard to envision how that doesn't end, and not end poorly, but sharply correct before maybe it doesn't end poorly for these companies. Just you hear the CEO saying, we are years away from any kind of scalable commercial revenue. We're not going to make any money till several years after that. But sure, give us a $20 billion market cap and we'll keep selling stock, and we'll keep telling you we're not real businesses yet, and you can keep making the Rigetti Computing CEO, I actually have a lot of respect for, because he's being very vocal about the fact that this isn't a real business yet, guys. Like, we don't have anything that works.
Cool your jets.
Anyone. And it's refreshing to hear him say that, rather the IonQ CEO saying we're going to replace Blackwell in 2 years. Come on, man. But I think we are in a bubble for AI infrastructure. That is my opinion. Bubbles can inflate for a long time. They can seduce people into betting against the bubble and losing a ton of money, not because they were wrong about what's going to eventually happen, but because they were wrong about when that was going to happen. And the when for me is way too important of a variable in this investment thesis to think that I can make a short bet against quantum computing names or against these third-party data center providers that are going to have no revenue growth as soon as AI infrastructure build out ends, whenever that happens. Yeah, so I think it's too important for me to be right about when that bubble stops inflating to make a big bet on puts or make a big bet on shorting these names. But I'm sure as heck not gonna buy shares because I did own. I had a few of these high flyers in 2021, entering 2022, and did some trimming, but it was 10% of the position when it should have been 90% of the position. Hindsight 2020, but live and you learn. And it really does feel like those corrections are coming for a lot of these I would say every single quantum name. I'd say a lot of the data center providers, some of the nuclear energy names that we're seeing just go absolutely bananas with no revenue yet. And it's all based on backlogs. These $300 billion contracts. We are seeing a company that makes no money and it has never made any money giving out to Oracle, the OpenAI contract.
Yeah, right.
And it's just, yeah, that works as long as you have capital markets that are willing to open up their wallets and say, how much do you need? No matter what, give us more growth. But that is very remnant of 2021. And that doesn't ever last forever. So listen to Sam Altman when he tells you we are in a bubble. And I guess for people who want to keep making a lot of money on the bubble, I would say be careful. Maybe take some profits if you want to, but what do I know? Do whatever you want. So I thought Palantir was ridiculous 40% ago, and here we are today. So yeah, ridiculous can get more ridiculous. I'm going to probably keep being vocal about it, just because I think it's helpful for some people who are maybe newer to this to understand that things aren't always this fun, and it can go down faster than it's going up right now. And you've done extremely well, and maybe if you want to take some chips off the table. It's important for me not to tell people to sell anything, because I shouldn't be giving advice. But in my mind, if I had one of these names in my portfolio right now, it would be that 90% trim. It would be that take it from 8% to the smallest position in your portfolio. Wait for it to inevitably get cut in half. Don't worry if it doubles again, because that's not the risk reward you want to take advantage of. And yeah, I think managing risk right now is so important, and it's extremely important while things remain this fun, which makes it a lot harder to do the right thing. But it goes back to a previous idea where we were talking about. I want to outperform the S&P 500 over a few decades. And in order to do that, it is less important for me in the next 3-4 months or 8 months, however much longer this lasts, to outperform by another percent or 2% or 3% than it is for me to guard against the extreme downside that it would take to maybe outperform by that extra 3%. So I am in lower portfolio beta mode. I am in take some high flying exposure off the table mode. I am in make the cash pile a little bit bigger mode. And while things can remain this fun, the probability and likelihood of that happening is quickly falling, and I'm taking advantage, or I'm acting accordingly. That's my opinion. Maybe this isn't a bubble, and it's the first time ever that we've had 100 times plus sales companies that aren't going to sharply pull back at some point. History is on my side, but history does not repeat itself. So we'll see.
But it does rhyme.
It does rhyme. And it seems like it's rhyming pretty quickly after just 4 years. So
yeah, right. Yeah, well, I think that's very well said. Yeah, you're welcome. I really like that idea, and I think trying to be prudent when everybody's going crazy, and you can always tell when things are getting a little frothy when Uber drivers are asking you, what do you think about this? Or what do you think about this? Oh, you're in the stock market. Well, what do you think about this? Okay.
When the undergrad buddies start asking me for stock picks,
right.
it is first of all, and best answer to that question is S&P 500 every single time. If they're asking you, what do I buy? You buy an index. If you're asking me that question and unconditionally doing whatever I tell you to do, please buy an index. Yeah, absolutely.
And thank me in 20 years.
Yeah.
Exactly. All right. Well, Brad, this has been a fantastic conversation. I've actually learned quite a bit today, and I've enjoyed it a lot. So if people want to find out more about you, what you got going on, you mentioned your newsletter and your website, please talk about that.
Yeah, and just throwing some praise back at you. I don't. This is going to make me sound bad. I don't have deep respect for a lot of people on X who I communicate with throughout the years, but you are one who I think does things the right way and goes about investing the right way and takes good care of their subscribers and their viewers and listeners. So fan of yours as well. But
thank you.
Stockmarketnerd.com is where everything is. So the website finally doesn't suck. So it'll be pretty easy to navigate finally. But yeah, that's where everything is. There's a lot of free content if you want to check it out. And if you want more, that'd make me happy. But if you don't, then I will still like you just the same.
Yeah. And I will put that in the show notes for sure. I'll put a link to Stock Market Nerd as well as X.com. And I think you're on a few other sites. I'll probably add those as well. So Brad, if you haven't figured it out today, Brad's a smart guy and he's a great follow and he really knows his stuff and you can learn a lot from him. I have through the years and I know you will too. So again, Brad, thank you for joining us today. I really appreciate it.
Thank you so much for having me.
You're welcome. All right. Well, folks, with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week and we'll talk to you all next week.